Hello, ladies and gentlemen. I'm Joseph Novichkov, Senior Trading Manager with GDM. Today's outlook, we're starting as usual with Asian shares. They traded slightly mixed on Thursday as choppy trade in the mainland equity markets kept a lid on risk appetite in the region. But also focusing on China's Shanghai Composite Index, it ended the morning session flat after falling nearly 1% and seeing, of course, a slightly modest rebound earlier in the day. On Wednesday, the Shanghai bourses closed up 3.5%. That was its biggest one-day gain in 1.5 weeks. On, of course, the hopes that Beijing could place the volatility in its equity markets. Also looking at the Japan's benchmark Nikkei 225 index, it was firmed on the back of encouraging offshore gains. Meanwhile, Japan's industrial output rose 0.8% in June according to government data released before the market opened, bouncing from the prior month's 2.1% drop. The dollar added about 0.1% on the day to 124.11 yen after rising as high as 124.19. That was its highest since July 24. At the line down under, Australian S&P 200 index, it enjoyed a broad-based rally on the back of modest recovery in commodity prices. On the domestic data front, of course, export prices dropped 4.4% on the quarter in the April-June period, widening from 0.8% slip in the preceding quarter. Import prices as well, meanwhile, rose 1.4% from the previous quarter, revised a dip of 0.2% in the first 3 months of 2015. That was the statistics from the government that was said. The Australian dollar, meanwhile, was moved at 0.7305 against the greenback following the data release, as well as the European equities are expected to open higher on Thursday as investors keep an eye on the continuing volatility in China markets. The euro edged about 0.1% lower to 1.0974 after earlier drifting down to 1.0959. Investors, of course, are looking for another chance to assess the interest rate hike with an update on second quarter gross domestic product due later on Thursday. While calling gains in the labor market were solid in its post-meeting statement on Wednesday, the Fed kept traders guessing on the precise timing of policy tightening. Gold in the commodity sector dipped toward its weakest level since early 2010 on Thursday, after the Federal Reserve said the U.S. economy continues to strengthen, supporting a potential interest rate rise when the Federal Reserve meets again in September. Gold dropped 0.3% to $1093.40 an ounce in Asia trade, and it sank to its lowest as $1,077 last week, its weakest since February 2010, after a sell-off in New York and Shanghai, and was since struggled to recover above the 1100 mark. Whether a U.S. interest rate hike, which would be the first since 2006, came in September or December matters absolutely little, as the next major support from a technical standpoint is at $1,000 an ounce. Oil prices extended gains in Asia trade on Thursday after a larger than expected draw in U.S. crude and gasoline stocks that strengthened the outlook for oil demand. But gains were capped by a stronger dollar. And of course, despite the drop in oil stocks, global supply glut is on the table, with OPEC members producing 3 million barrels per day, more than demand in the second quarter. Also, we're looking at the U.S. crude stockpiles from the report yesterday fell by 4.2 million barrels in the week to July 24, more than expectations of a decrease of 184,000 barrels. That was data from Energy Information Administration. And the most important event today in the economic calendar is the U.S. Gross Domestic Product preliminary report later on today. That's all for today. Thank you very much for joining us. See you next time.